Roger, Richard, great, fantastic. Okay, everybody can hear and see. Steve, I'll hand over to you. As always, we sort of just appreciate a rundown of the main indices and highlighting anything that you can see that you think is worthy of noting for hungry traders.
Okay, no problem, Simon. Okay, good afternoon, guys. Right, well, I think the main thing that I've kind of picked up the last kind of few weeks is that a lot of people are struggling with kind of correlations and reason why markets, especially the FX, are moving in the way they do. So I'm going to kind of focus on the bottom right in the short term. Now, we've got this problem, and we've had it for quite a while now in the US. They are trying to lead by example. So we've got Janet Yellen, with his forward guidance, trying to explain, what's going to happen in the kind of coming months, weeks, years, what's going to happen with interest rates. Now, what's really kind of confusing for a lot of people is that they like to take the Fed the word. Now, if you've learned anything about the Fed and the government and the world in general, is to kind of not really kind of, believe too much of what they say. Now, there's a reason why you hear things like Bloomberg polls or, statistics and this kind of things, to how the market's priced in further movements. Now, markets don't really move on the what is known. The trouble is that what is known is in your charts. So what you've known is here. Yeah, it's this movement here. It's what's happening on the left of the chart. What is going to be known, yeah, and what the future and where you make your money is to the right. Sounds simple, doesn't it? But a lot of people keep forgetting that this right area, this gap, towards towards your scale, is where all the money's made. It's not made here, right? Unless you're kind of holding along from here, and looking to get out here, then that time's gone. It's gone, it's past, you'll never get it back. The money's to be made in speculating on what we know now, yeah, and where the market's going to be in the next 5, 10, 15, 1 hour, 2 days, whatever it is. So we'll go back to that kind of interest rate kind of story and journey that we've been on. So Janet Yellen said we're going to put interest rates up. Okay, so last year we were expecting 3 interest rates and we got 1 hike. This year we're expecting 4 interest rate hikes and we've got 1. Now, the market pretty much discounted and priced in straight away that we weren't going to get 4 rate hikes. So if we're going to get 4 rate hikes, and again, when we're looking on the higher time frame chart, yeah, when we were talking about it, 3 rate hikes is still pretty good, considering we only had 1 last year. So we're all expecting the dollar, again, against the yen to go up. But it didn't. What did it do? It went down. But why did it go down? Well, a lot of people say it's because, the market priced in we're not going to get 4. But the real reason the market went down is because all the speculation, time and time again, the interest rates were going to go up, was done here. So all your big boys, all your institutions, your Goldman Sachs, the big players have got long here, averaged in here. So we get to the top of the market, and everyone that, is that good little student, that, I've read the economics, I've read the fundamentals, what should happen? Interest rates, well, if interest rates go up, we should buy some dollar. Great. Well, if you know that, not that difficult, is it? If you know it, I know it. If I know it, then, all the kind of big players know it. So what they do is they sell the market because they're still long. And what they don't do is they don't close the gap. They don't make any kind of technicals become overly complex. And again, here we have, as Simon said, my old friend Fibonacci. 50% is at 109, spot 922. So in the short term, after all that selling, people scratching their heads going, I don't know why this dollar keeps going down. Surely an interest rate going up is good. It is. But it's back to my old saying, trading's about being right at the right time. So if there's an opportunity in the short term, yeah, short or medium term, to make people think they're wrong, well, then that's how the market capitalizes. That's why, your Goldman Sachs traders are making 10, 20 million quid a year, and you're not, because they have the size, they have the account, and they have the ability to do what other people cannot, which is make the market do things that they're not comfortable with. So as everybody's getting out and not understanding why the dollar's not going up and making, highs above 130, like it should do, like we've all analysed, everyone's gone down, lost money, scratching their head. So we get down to the kind of nitty-gritty on your kind of weekly levels here. Then what do? Well, the market then starts to rally and go up. So people are getting excited again. Okay, but it's like, well, maybe then, we're going to get a rate hike in June. I don't know. Donald Trump says he wants a low dollar, but Janet Yellen still knows more than Donald Trump, because really anybody knows more than Donald Trump when it comes to economics. So, again, we're going to kind of price in buy. So again, and then the weeks coming to that, all the kind of pain has been taken. People have been kind of squeezed out here, yeah, pushed up here. in the short term. So the market is any kind of strong directional move that I've talked about a million times will retrace to 50%. So we've got the market, yeah, this strong directional move, haven't made a new low, haven't made a new high, yeah, double top here, has come down, yeah, and it's hit the 50%. Now, granted, it's got down and it's pushed through towards the 61.8, but then again, that could be another, almost kind of squeeze mentality where we just get the weak longs out here, because again, remember, all the big players still long, from way back in the charts. Then hold strategically above that 50% and that 109.922. Again, our targets 38.2, 23.6, and ultimately to break these highs and get back and make new highs. So very difficult, isn't it, to see that if the UK are going to put rates up before 2019. It's looking less and less likely with Brexit. The EU haven't really got a plan, to be honest. Mario Draghi doesn't know what he's doing, but I can say that interest rates going up in the EU anytime soon are very unlikely. So even one hike that we've seen is enough for the market to say, okay, well, what we'll do is in the short term we'll go against the market and we'll justify it in any way we want. Say we're not going to get 4 hikes, we'll sell the dollar, blah 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 blah. But the reality is we're expecting 3 rate hikes this year. We've seen one with more than 80% chance, in my opinion, and I'm one of the people that votes in these polls, to see the rate hike in June, and then the rest of the year, who knows? We're already talking about 3 rate hikes in 2017, so much more opportunity for the dollar to be bought from these lows and to go up. So your strategic points, again, are your Fibonacci. So you're looking for the pivot, hold above 102.99, then a break above 119, and then I would say 124, and then one kind of 36, if I remember rightly. For me, looks like a nice kind of, I've not got the extensions on anymore, but kind of at the 136 level up here, looks like a natural place of where the dollar would be happy. And again, the Japan economy, in lots of trouble. They can't create enough people. There's 2 people for every job, that's advertised in Japan. So the kind of growth aspect in Japan is very limited, and no matter what you say about Donald Trump, he's opened the checkbook. He's going to be, blowing some bombs up. He's going to be spending some cash. He's going to be doing some stuff. So essentially, it doesn't really matter, does it? Kind of what happens in the rest of the world. If the US are going to kind of spend their way out of trouble, which historically they've always done, then there has to be some demand for that dollar again. So just going back, cycling through to your weeklies, your dailies. Again, these are your levels, and you can see. These consolidated levels that look interesting. Yeah, the good buying points. So as I've said to you, in previous webinars, sell the euro high, I've pretty much always said as well, buy the dollar low. So these low points on your dailies when the market closes, yeah, we close around here again today, then again, buy. You've got your resistance points. You know where the market's going to go. Where it's been in the past, yeah, it's more likely to go in the future. And the trend for me with interest rates, in the US versus the rest of the world, even if we see 2 hikes in the next 2 years, it's still going to be more than the pound, more than the euro, more than any other country that's really, the markets care about. So again, in the kind of major correlations, you buy that dollar low. Now, a lot of people have been saying the correlations aren't working. So you can see that when the dollar sells off, sometimes, the euro has been selling off and the pound's been selling off as well. So that's what's been catching people out. Now, the dollar yen is the straight battle in the markets between interest rates. When are the US going to hike rates and how many and how quick? The euro, dollar, and cable are a little bit different. They're not as sensitive right now to that interest rate decision because Europe and the UK got its own problems. And that problem being Brexit. Now, the kind of battle between the euro, dollar, and the pound dollar gives it a level playing field. We'll go through the euro pound in a little bit because obviously that's where the main battle you would think you'd be having. But you have to remember on the global scale that people are interested in the UK and they are interested in the euro. But also on the same point, they're not interested. They're interested in making money. So they don't really care about the outcome of the UK. They don't really care about the outcome of the euro. What they're trying to do is get an edge. Now, what you have to realize as well about your bigger institutional clients, your bigger institutional trading houses and stuff, they don't just trade pound to point. These guys are trading huge sums and they're trading it in baskets. So they're looking for an edge of multiple currencies. So that's why you're not seeing the dollar sell off and everyone get excited and buying the euro and buying the pound, because there isn't that outright need to be buying a low pound, or indeed selling a high euro. There isn't that institutional demand. What they're trying to do is get as much size through the markets, and balance out that risk, because they've got a slightly longer term view. They put more size through, so they have to hold positions for longer. Now, this is another thing that I touched on when I did the Round the Clock Trader live event a few weeks back in London. There's more than one way to make money out of the markets, and just trading money makes money in the markets. Now, you have to look at trading as a business. If you only ever trade small size, A, you're only ever going to make small trader money, and B, you're not going to have the advantage of what trading volume actually means within a business perspective. I treat my trading like a business. I can make and lose 10,000 quid in a day. It makes no odds to me, okay? Because I have a big account, and that's what I do. If I lose £10,000 in a day, it won't be because I've held £200-300 a point, and just watched it go offside. It's because I've traded a number of things over products a number of times, and I've just been wrong. I'm allowed to be wrong. I'm right more than I'm wrong. Now, what you don't understand is if I lose £10,000 in a day, and I trade the aggressive style I do with averages, and I trade maybe, I don't know, £5,000 or £6,000 worth of costs, I will get back £3,000, yeah, to me, because I trade volume, I trade size. Now, this is the advantage you get when you trade the markets within the kind of realms of the professional trader. The market will pay you back for being involved, for providing liquidity. So you might have lost 10 grand, you get 3 grand back, you've only actually lost 7 grand. Sounds bad, I guess, your average trader, but then if you have a winning day, yeah, and you make 10 grand, you also get 3 grand back for your trades. So win, lose or draw, you're still getting paid if you put volume through the markets. Now, this is how I take good traders to be great traders to be professional, outstanding traders, by understanding that you have to trade the markets and act like a business. If you think to yourself, if you can generate X amount of money per month, then that could be your wage. So as long as your capital grows ever so slightly, then you're still massively up in the game. How many people out there have traded your account for a month and made a little bit of profit? Too small that you can't take it out, or you've lost a little bit of profit. Too small that you don't want to take money out. So you spent maybe 60 hours in front of the screens and you've made nothing. Not that it ever happened these days, but if I was to spend 60 hours in front of the screen, I'd make sure I got paid at least £10,000 a month. At least. If I didn't, what's the point? Why am I going to be involved in the markets to be pushed around and bullied around just for the fun of it? And you can do that too. The markets are moving all the time. Okay, you might not understand the correlation between the dollar, between the euro and cable. Doesn't matter. The S&P. What have we learned for the S&P? Stock markets in general. If you sell them and hold it, you will lose money. Monthly chart. How many times have we gone through this? Rejection, higher, rejection, higher, rejection, higher, rejection, higher, rejection, higher, rejection, higher, rejection, higher. The interest rates still where they are. It's not tempting enough for people to put their money from a risky investment in stocks and put it in cash. That time will come. So the crashes are going to come from, or the corrections are going to come from people getting frightened about stock markets. They're not going to get frightened. What they're going to do is see a better, safer alternative to someone to put in the money. So they will get out of risky investments, which stocks are, yeah, and then put it in the bank. And what will happen is we'll see the spikes on the upside. So we'll see rejection, hold, rejection, hold. And you will see all of this gains here probably wiped out in a week or two. And you can see easily the market's trading below 1800. And it might be, as I said, all that speculation is in the future here. So expect being right at the right time. So the expansion points, yeah, we could go as high as 2,460. 2,500 even. Yeah. So what happens is if you want to sell it and hold it, you've got to be able to take all this pain on, because that's where the markets could be. And they could hold, they can hold, they can hold. And then in 1 week, they could do that. Yeah. In 2 weeks, they could do that. In a month, they could do this. But that's speculation. It's in the future. We don't know. What we do know is when the charts are as they are now, when you see a significant point, dotted line, buy it. Dotted line, buy it, buy it, buy it. And the market continues to go up. So don't sell something that doesn't want to come down. When you see the wicks like this reversed on the upside and it holding, then get involved and sell it. So if you want to know an easy correlation, buy the stock market's low until interest rates get above 1% in the US, or get above, 150. Anywhere above 150, then when you're talking about the institutional clients, people that I have that have billions of pounds, they're not interested in big returns. Yeah, this stock market rally has just been a bonus. It's made the 1% even richer, sickeningly, just by them having nowhere else to put the money. But when they do want to pull that money out, it's going to go back into the bank. And that's going to be in pounds, and it's going to be in dollars. It ain't going to be in euros, I'll tell you that. So again, something else to think for when the stock correction comes, where the safer haven currency is going to be. For me, that is definitely the pound. Definitely the pound. So I see big upside in the pound. But anyway, just going back to this kind of idea that if you want to kind of trade intraday, well, just look at your hourly charts. Yeah, you see anywhere where there's good consolidation around these lines, you just buy them. Yeah, the 50% pivot. Oh, you buy it and it gets to the red lines. I mean, it's how hard do you want to make trading to be? I don't have any lines. All these lines are pre-drawn on iView charts. Okay, they're just always there. They predict market movement, so you don't have to be a great trader. You don't have to be a great technical analysis. Just to pick up your screens and go, oh, stocks, yeah. When they get above the 50%, Steve says buy them. Buy it. There you go. The S&P made itself 34 pips. Yeah, where else have we got? So we're below the 50% in the DAX and the FTSE. So they've got the ability to go higher, don't they, if they're going to follow the S&P? So you buy them low. Well, there's a point of support. Buy it low to 50%. DAX, there you go. Buy it 12692.6 to 50%. Or whatever you think is going to happen. Again, with gold pivoting around that 50%. So stocks are going higher, yeah, and the dollar's going to go higher. What does that mean for gold? Well, risk off. Yeah, higher dollar, more expensive gold, people sell it. So it's going to break here. Yeah, 12555. Then it's going to get back down to 1252. So again, it's putting these things in correlations, but use them in the right way. If you're trying to trade, cable, or you're trying to trade the euro dollar off the dollar yen, or off the dollar index in general, it's very difficult because the dollar index is solely focused on the US, on Trump, on its policies. Yeah, it's the biggest currency. They've got the biggest army. It's its own entity. So you don't necessarily get the correlations and triggers in the pound and in the euro against the dollar at the minute because the dollar's got its own problems. So what we're trying to figure out is, what's ticking away, what's making the euro and the pound move? Well, it's the Brexit argument. Who's going to win that? Lots of talk in the press about how great the European economy is doing. I mean, GDP in UK, and the FT said today, was rubbish compared to, Spain. Spain. Who cares about Spain? I lived there for 8 years. If you think Spain's going to up and booming, you got nothing coming. It's the same generation that are still booming. They've still got massive unemployment in the youth. They've still got massive problems in the property. Still got massive problems in pension. Yeah. So all these things are all related. The GDP might be better than it was, month on month in the UK, but it's still rubbish compared to where it was, 15, 20 years ago. So these growth figures can be spun however you want. At the end of the day, the new norm is that we're not going to see these huge jumps in GDP. I mean, look how China, how they were downgraded by Moody's. No, first time in 30 years. Because you can't trust anything that comes out of China. They've got these ghost cities. They don't really kind of play by the rules. They just say whatever they say, and we have to believe it. Well, Moody's have said for the first time, no, I don't believe it. Okay? So if they don't believe that, then why necessarily should we believe any kind of data or any kind of real impact on this data? At the end of the day, people are going to demand something in the markets. They're going to want something to buy and make money, or they're going to demand to sell something in order to make money. People just want to make money. This idea that gold is going to be the strategic reserve anymore and it's a protection against inflation, the store of wealth, is nonsense. That store of wealth is nonsense. If you wanted kind of uncertain times, we've had the most uncertain times in history in the last 2 years. Brexit, Trump, terrorist attacks, blah, 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 blah. If any of them are really going to, put gold back to where it should be, where it has been, yeah, then why are we not trading up here? Why are we trading at 1600? Because all the speculation for the hedge funds, the cash for gold, the pawnbrokers, all that kind of stuff was done here. Yeah, that was the speculation. It wasn't on fear. It wasn't on people protecting the money. It was on greed. Greedy, greedy, greedy. I've got gold under my bed. Cash for gold. I've got granny's earrings. Greedy, greedy, greedy. Yeah, markets go. Well, actually, UK has sold its gold reserves. US, Fort Knox is empty. Who's got lots of gold? I don't know. Russia, China, India. We don't care about them. Sell it. Yeah. Oh, there's fear in the world. Well, sell it. Oh, what's the fear in the world? Trump. Oh, buy some. Oh, yes, go to your old-fashioned IFA. Yes, yes, Mr. Broker. Buy me some gold. No one cares. Sell it. Goes up a bit. World's ending here. No, it's not. Hold below the 50%. Magic fib level. Yeah, I've said that once. I've said it a million times. 1301.63. It might touch that. It might get back. But it's got no chance of getting to 1400. No chance of getting to 1500. No, it will never, ever get back to 1900. What it will do, we'll just figure out that the world's had to pay for the quantitative easing, had to pay for these secret military missions in somehow. And what's the easiest way to do it? A big fat gold bar. Supply and demand. What's the latest thing? There's 1.3 trillion bajillion dollars worth on the ocean floor. Supply and demand, people. What's going to happen if that supply hits the market? Yeah? Think about it. We're not actually that short of gold. Gold is just a store of wealth, an old-fashioned store of wealth. It takes a lot of time, money, looking after. Much easier ways to store money. Bitcoins, up 88%. Yeah? What does it cost, to secure a Bitcoin that doesn't exist? A lot less than it does to secure, a boatload of gold. So what's going to happen? Old-fashioned people that believe that store of wealth stuff are going to die, hopefully soon. Hopefully it's a lot of boomers. And then they release their money. They give it to the kids who are ungrateful and disillusioned and sell it. So just like house prices, just like gold, it'll all come crashing down because it isn't actually as important as people make out. So you make me any kind of argument that gold gets above 1300 and there'll be a special prize for someone that convinces me to go and buy gold. But for me, technically, fundamentally, everything I've said from the kind of technical levels, it's just a relief rally. All the market wants to do is sell gold. It wants to break back below 1206. It wants to get back to below 1102, and it's going to get to $1,000. And then below 1,000, you could see it drop $200 in a matter of weeks because that's all the stops are out. Don't know. As I say, anyone's got a better argument than that, then just send it to me. The DAX, the FTSE, again, the FTSE's been very uncomfortable above 7,000, 7,300, but it just carries on with the trend. It just carries on buying, and I can't really make any other logical reason than it's just that lack of alternatives to put your money. People have been, scared off by bonds. People, were over-investing in property. People have diversified as much as they can, so the stock markets are just having that kind of run. And, if you talk about the 1%, top 5%, 10%, they've got so much money combined. They're the people that are buying at these levels, and they can keep the stocks as high as they want. And if you think about Trump's administration, well, it's essentially a lot of old Goldman Sachs bankers. So, the market is going to correct when there is a viable option, as I say, in cash, or when Goldman Sachs say to their rich guys, you know what, guys, off we go, sell away. Richest family in Turkey apparently spent $600 million selling shares the other day. So that's a lot. That's a lot. I personally have people and I have people around me that have billions. Yeah, I know the top 1% of the top 1%. So when they go to liquidate their holdings and and the shares and stuff, that's going to move markets. It's not your average man on the street. So you have to think the markets are being moved. I don't want to say the word manipulated, but they're being held at these high levels because of higher powers. People that just have more options than your average man on the street. Now, you don't want to get drawn into that. You can use that as an opportunity. At the end of the day, I've always told you, we're not in these markets to buy and hold or sell and hold. We want to be right at the right time. We want to be making 10, 15, 20 pips out of the market. We just want to be doing it on the right kind of size. So if you're doing that on £50 a point, £100 a point, £200 a point, you're making good money. And that's how you do it. You compound these wins every day. You don't have to buy the market low and have all that risk on the table. Leaving money on the table. That's the biggest problem that intraday traders have right now. They don't like the intraday movements because it's hard. And you have to be very patient, very disciplined, and you have to be like a sniper. When you see it, you've got to hit it, because if you don't, you've missed it. Yeah, but they don't like that. They want to kind of be handheld through the markets, and they want to use an indicator, or I want an oscillator, Steve. I want like 3 things before I trade. The market doesn't give you that anymore. The market doesn't want to do that anymore. You have to change with the market conditions. The markets want to move in a way that you don't understand. The markets want to move on any old bit of news, some nonsense Trump tweet. That's what they want to do. So if you don't like the way the markets move, Stop trading. It's just as simple as that. Don't beat yourself up. It's a tough game. It's very hard at the minute. So if you're not enjoying it, stop doing it because you'll lose money. If you don't understand it, stop doing it because you'll lose money. There are a lot more ways to lose money in trading, yeah, than there are to make it. The only way I know how to make money in trading is to use size. Is to leverage up what capital you've got, use it responsibly, but use size through the market. Because if you come, for instance, this whole mentoring stuff, I mean, I did a presentation with Simon in London, and I told people that if you're with any other broker, pretty much any other broker than the one that I'm the chief market strategist for, Intertrader, then they're going to trade a B-book. That means they're going to be looking at a big screen of all your positions, and they're trading against you, and have been doing for years. And people are like, oh, I didn't know that, right? Well, just move broker. You know, you switch your mortgage, you switch your credit card for a better deal. Why let somebody make money off the back of you? It's insanity. You know, and if you come to me, I can arrange it, and I heard the last guy talking about overnights and stuff. I can arrange your swap rates. You know, and again, if you're trading any kind of size, we can look at your hedging options. Yeah, we can look at trade back. Yeah, I can look at paying you for every time you trade, win or lose. Does your broker do that? Well, no. So there's three things why your broker's against you. What loyalty have you got to your broker? What have they ever done for you? Nothing. So go to somebody who's going to have interest in you. Now, if you want to come to me, I've told you. It's very simple. If you've got £25,000, yeah, in an account or more, I will give you a miles better deal. And I'll do it through me, yeah, Steve Ruffley. Because I am somebody, an intrader. I'm the chief market strategist. I've been for 6 years. I can make anything happen. But if you've got less than 25 grand, don't expect as much help. You know, money makes money. I know lots of people have had things to say about the videos and the way, you know, I'm like, you know, the guy that tells the truth, people don't like it. Well, you don't like it, I don't care. I'm not here selling anything. Yeah, why do you think my services are free? Why am I looking out over the beach with my swimming pool? Yeah, why am I, you know, with my dog walking watch, a Rolex? Yeah, because I make loads of money. Make loads of money. People pay me lots of money just to be around. So if you want to be part of my world and get involved in these things, you've got to invest in yourself. And it's only 25 grand. That's a starting point. But if you want to make money in the markets, it's like setting up a business. You need to be capitalized. And if you don't have that capital, your chances of going into the markets with 50, 100, 200 pounds a point, nicking a bit of S&P here, yeah, making yourself a couple of grand a day, they're gone. And what you end up doing is buying a pound here and hoping it's going to go up for 3 days and checking it on your phone and putting all that effort, all that emotion in for nothing to make 100 quid. Yeah? Go and work. Go and work somewhere. You know, go and do the gig economy. You know, go and put yourself on, you know, one of these ad sites. I'll walk around with a banner on my head saying, buy stuff at Tesco's for 100 quid. You know, do that. You think about how much people physically invest emotionally, time-wise, you know, intellectually wise, in looking at these screens. These screens are just spitting out money, but you have to be willing to get hold of it and do the right things. Because if you're just buying and holding, leaving money on the table as it goes up and down, it's just ridiculous. It's stupid. You're shooting yourself in the foot every time the market has any kind of significant move. I mean, really for me, it's difficult to see how high the FTSE is going to go. Now, obviously, the pound dollar has been an interesting one. You know, lots of times you've seen, obviously, you know, kind of this break towards, you know, kind of 130 and holding significantly above it. You know, we've kind of gapped down, we've kind of failed. Another great kind of indication, you know, the market didn't really know what to do. So a big spike up and then a big kind of sell-off. If you look at the pound, you know, versus the dollar and the pound versus the euro, as I've said, it doesn't look bad, but in the short term, it's very hard to make a justification for it to be great. We know against the US, they've got their own thing, you know, they're to do with interest rates. So interest rates are more likely to go up in the US than they are in the UK. But the whole thing with the European Union is it's 1 against 27, and it's 1 against, you know, Europe. So the markets like to think that we're the weakest link in this, you know, that we're the ones that are going to suffer the most, and they might be right. You know, they like to jump on our GDP, they like to jump on this, that, and the other, but the way I look at it is, we've had a bounce off the lows, okay? So we had a bounce off the lows. That's natural. People are just buying it. The pound is always going to be around. The UK is always going to be around because we've survived it. We used to have the empire. We're a lot smaller than we used to be, but we're small and mighty. No matter how you look at it, it's not in the world's interest for anything to happen to London, let alone the UK. So intrinsically, there will be value in the pound. So we've seen this bounce. And these are decision points now at 130 to say, is the pound going to be better value than the euro going forward? Well, it all depends, doesn't it, how good Brexit turns out. Because if we start to make trade deals and the European Union get wobbly, and there's a talk of Frexit, Netherlands exit, whatever exit there is, or Greece go pop finally, or whatever, the Eurozone has a lot of moving parts. Okay, a lot of people to please, a lot of decisions to be made. The UK only has one moving part. So you can see that as we get closer to making trade deals, as we get closer to this idea that that this break from the European Union is going to work for us, the more we hold above these lows in the dollar, irregardless of what interest rates do, the world will be looking for a second, global safe haven currency, because I just do not see it being the euro, and I certainly don't see it being the yen. We've seen what happened with the Swiss, New Zealand dollar, not a chance. Aussie dollar, not a chance. Renminbi, yen, no. So the pound is always going to have that intrinsic value. So that's why all along these lower levels, people can buy, and see some value. Now we might see it dip back down towards 120. And again, that can be because of negativity with the Brexit deal, negativity with, politics in the UK, anything, terrorism, all these unknowns. But what's not ever going to go away is that people tie money up for a month, a year, 10 years, 20 years, 100 years. So, there will always be this idea that what's going to be around in the future. Will it be the euro as we know it? There's been talked about, breaking up into north and south. There's been talked about this, that, and the other. I mean, if you look at the euro chart, it's very much like this. We go back to the euro dollar. Same scenario. Very much like this, it just hit the lows and we're all thinking it could get to parity. And we've seen a bounce, but it's a relief bounce. It's not a bounce any more than a technical bounce. Still in this channel. There's a down channel here. So you could easily get to these points and in a couple of months we easily be back down to 106841. It's got every opportunity to come down. And again, everyone likes to talk up the euro and how well it's doing. It's doing well, compared to its almost disastrous past. Almost disastrous past. And you look how aggressively the market sold off, bounce, sell, bounce, sell, bounce, sell, bounce, sell, sell. So we have the bounce, but the bounce is going to happen. It's going to have to get above here. We're going to get above 1.1952. Maybe to 130 for it to be a significant bounce against this selling. So for me, days of the euro being high, especially against the dollar, are numbered. And Mark Carney, Mario Draghi can make a case that they've kept the central banks respectable on a global scale, but still look at the problems with the Italian banks. Look at the problems with Greece. They continue to be come and they're swept under the carpet. It's like, do you think the ECB is this magic money machine that can just rely on Germany making all the money? How long is that going to last for? What, forever? No, it's not going to last forever, is it? So there has to be an idea that one currency is going to pay for it or not. It's not about losing, because again, we're not interested about holding these things for considerably long periods of time. So we just look to sell the euro high. So on the hourly chart, again, you sell it high and you get back to the 50%. So again, the trend in the short-ish term is up. So maybe you want to buy the euro against the dollar here, and look to get you 20 ticks, 10, 15, 20 ticks up here, or you put your stop there and you sell it. And you make your 12 ticks, or you get down to here, make 30 ticks here. Look for interesting points. We're at an interesting point here, intraday, the 50%. So for me, I'll be selling this, buying it back here. Job done. That's how you trade. Simple. And you just go through each chart there, looking. Sell the euro high, buy the dollar low. Where's it going to get to? The 50%. And you just look through each chart and you do that every day. And if you can pick 10, 15, 20 pips 5 times a day out of the markets, on decent size, you're going to be doing well. I mean, that's really, again, Fibonacci. We can look at some other kind of easy Fibonacci's on your dailies. So we're looking at the pound New Zealand dollar. So again, you look at the pound New Zealand dollar over history. Then again, we've seen this massive sell-off. Brexit comes in, sells off even more. But, we used to be at 2.4. Then we were down to 1.68. So what are you going to do? Well, there's going to be some value somewhere in there. New Zealand's 4.8 million people. What are they going to do? They're not changed the world, are they? So, you know, you're going to see a bounce. So you see the market bounce, but you buy low. Look at these fib points. Yeah, just keep buying the fib points and it comes back. So again, the weeklies, 50%, you know, just above here, 108.8. So you're thinking, well, is it going to break and, you know, sell all the way down here? Well, what would the reason be for that? I don't know. I mean, this consolidation period looks like it should go higher. So maybe we get back to the 50% and we buy. We've got these previous targets to get back to, you know, 2, that 50% of the entire move. Looks like a good level. Yeah? 4.8 million people versus the UK. I don't know. Who's going to make the most money? We'll see. And then, you know, again, on your kind of daily charts, you know, looking for just kind of correlation. So these are your fibs on the daily. Then you look at like the euro versus the pound. So again, you can say that, you know, the euro against the pound been pretty strong. Where's it going to bounce from? 50%. Where does it start bouncing from? The 50%. Where's it going to get to? The next 50%. So if we're thinking in the short term, if the euro is going to be more valuable than the pound going forward, well, then you just pick a place to buy. I mean, it's not a coincidence, is it, that the market keep picking these lows? Well, these points of interest, should I say? Yeah, you know, these fibs are just simply based upon movement, where the market's been, therefore where it can go to. So anybody any questions or thoughts? I mean, I've been whittling on now for nearly 40 minutes. Anything you guys would like to know? Or I mean, I've been through fibs a million times. You know, again, it's people tend not to want to have the confidence in their own analysis, but, you know, Fibonacci gives you that. You know, all you have to do is pick a move that hasn't broke a high or a low, and then it pivots around the 50%. It's either a strong directional move or an individual candle.
Steve, it's Simon here. There are a few questions, comments rather, going back a little bit. Are we saying that Bitcoin is taking over from gold?
Well, I mean, it's hard to argue, isn't it, with the kind of Bitcoin success? And it's not that I'm trying to argue with it, but it's it is what it is. You know, Bitcoin is unregulated. So when it's unregulated, you have this ability to lose 50% of your investment, or you have the ability to make 88% in a week. I mean, it's unregulated. So is it taking over from gold? I mean, it's not taking over from gold, because I've said for all these different reasons that I don't think gold is what it used to be. You know, when I first started being, you know, doing my trading to be an IFA and all these kind of things, you were talking about a balanced portfolio. You know, have some amount in stocks and shares, you know, some amounts in commodities, some amounts in, you know, kind of fixed assets, and, you know, there's a kind of really defined ways of how to build a balanced portfolio. But I mean, what's a balanced portfolio these days? And how can you balance it? You know, it's practically impossible. So the reality is that, you know, this kind of missing link of that safety part of a balanced portfolio, or any kind of portfolio, isn't really being fulfilled by gold. And as the world becomes more savvy, more tech savvy, you know, more kind of turned on by, you know, unicorn stocks, tech stocks, Bitcoin seems to be something that is interesting to people. I mean, how can you say it's a replacement for gold? I mean, gold can drop, you know, so much in a day, so much in a week. Gold's not going to move 88% in a week. It's impossible. And if it did, it's because the world has just let off a nuclear bomb and everyone's dead anyway. So what's the point in anything? So gold cannot do that. It cannot do it because there's too much time, money invested at every level. The problem with Bitcoin is that nobody really knows its value. And it's not regulated. So, you know, huge volumes can come into the markets and take stops out, take prices out, because there isn't that history. There's not security of people trading throughout the ranges, you know, trading at every single price historically. So, I mean, it's just moving into the, you know, into the modern world, isn't it? I don't think it's taking over from gold. What I think it's doing is it's just becoming what we call like these alternative investments. And I don't know anybody sensible or anybody, you know, that's rich that has any interest in holding Bitcoins, because they're not looking for an 88% return. The people that are looking for an 88% return are, you know, millennial investors, you know, people that want to punt, people that want excitement. Yeah, people that have made the money and made that over time want a return to maybe 3%. They're not looking for 88%. So it's never going to replace gold in a traditional sense, because until it's regulated, until someone like Goldman Sachs or Morgan Stanley, which they have done, you know, apply for these cryptocurrency licenses. Until it's somebody like that, you will never get any serious paper or institutional money in it. So it will continue to be volatile, and it will just be a news headline. Bitcoin went up. Bitcoin got stopped in China and it dumped. It's now worth flipping 10p. You know, these are things I've been talking about for so long. You know, I'm not interested in that kind of, you know, that kind of punt mentality where it's like, you know, you want to make huge returns on little amounts of money. That's not how the world works anymore. Yeah, for every guy that's made a fortune in Bitcoin, there's been a million people that have lost it. So it's an alternative way of investing. That's the only way you can look at it. Until it's regulated, it will never have any serious place in any, you know, institutional or any kind of higher end, you know, portfolio. But good question, yeah, good comment, good thought. I like that. Anything else?
Yeah, thank you for that. Let's moving on. Oh, Steve, you sound a bit bitter and twisted today. Says Gary.
Not more better and twisted than usual. I've had 3 webinars today, and you know, I've had conference calls and stuff. You know, I've done 4 hours work today. I mean, that's like a full week's work for me, and it's about 300 degrees, and you know, it's hard. It's hard to keep the motivation. Remember, I do these things for you for free,
And you keep reminding me, Steve. Thank you for that. Okay, British pound better than the Swiss franc? Ask Yat.
I mean, again, I mean, the Swiss franc was the darling, wasn't it? It was the place to go to, you know, as was the Norwegian krona when you wanted a safe haven currency. But when they removed their peg from the euro, what did we see? Well, we saw companies going bust. Alpari, yeah? Alpari that trades against you, why did they go bust? Why did FXCM need 200, 300 million bailout? Because they were trading against you. So that's why they lost that money, okay? Because they were overexposed in the market. Are they viable alternatives? I don't know. The world seems to be turning its back on capitalism to some respect. There seems to be a lot more transparency, a lot more kind of understanding about the trust world, you know, that kind of a lot of my clients are involved in. You know, they want that transparency. So this kind of idea of holding money, you know, in different countries is getting harder. It's getting more difficult. It's getting more taxable. So I don't see the different things. I think the long-term established currencies, you know, are, you know, the pound, the euro, and the dollar. Now that's set in stone for me. That's not going to change. You know, you kind of people that want to hedge off risk, you know, and do that in currencies like the Norwegian krona and Swiss franc are becoming less and less abundant. There's less of them. And this again is how the landscape of the world is changing. That's why gold's not at the highs. That's why people are jumping in to Bitcoins. Why people, you know, are investing so much money in things like Snapchat. You know, I still don't understand Snapchat, and I'm only 37, but it's worth $1 billion. Whatever, great, nice one. People are much more happy to have Snapchat as in their diversified portfolio because it's there, it's in the news. Mark Zuckerberg, you know, 3rd richest man in the world. They kind of get the future, the currencies and that kind of stuff. It's a dying breed of people. It's a dying part of a portfolio. So it's not that if a currency is better. It depends what your reasons are for doing it. What I would say is there are better opportunities to trade maybe the pound against the Swiss with that view that maybe the Swiss is a dinosaur, you know, with a very high standard of living, but, you know, closed off. And as the people that can, you know, have access to that world get less and less and less, then perhaps on a global scale it becomes less attractive. You know, London's only going to keep growing, so maybe that's, you know, the pound becomes more attractive. So you buy the pound against the Swiss. So, you know, that's the views you want to take, but that's longer term, you know. And again, what you're trying to do is zoom that down onto an hourly chart or a 15-minute chart, stick on iView charts or some fibs, and just say, right, well, in the last 3 weeks, the pound against the Swiss has done this. Okay, it's low. I think that's value. So you look for long trades between those levels. Simple.
Steve, there are a lot of questions coming in about Fibonacci. Obviously, where do you place the fibs, and how do you find the right Fibonacci, etc., etc., etc. What I've done is I've placed a link in the chat box. I've just sent that now. That's to your presentation that you did in January, particularly on Fibonacci trading.
Absolutely, or just go onto Amazon and get the Rough Guide to Trading. You know, it's only 20 quid, And that has, you know, 3 really good sections on your Fibonacci: your overextended move and your strong overextended candle and your strong directional move. If you just buy it for those 3 chapters, it's worth you 20 quid. Get it on the ebook and just read it. I think it's like 8 quid or something. And I can't be bothered, you know, going through the whole Fibonacci thing again. It's a strong directional move, something that you draw from an extreme to an extreme. Okay, so as long as it doesn't make a new high or a new low, that 50% is the pivot. Once those high and low are broken, yeah, you have to find the new Fibonacci. That's as simple as I can make Fibonacci. You use the past to predict the future.
Yeah. What kind of monthly percentage could you expect to attain using your system? Asks Gordon.
It really does depend. And again, it comes back to the amount of money you've got. I've got people with 100 grand accounts that are making 30%. I've got people with 10 grand account that are making 5%. I've got people with £100,000 plus that are making 0% because they just sit there and watch it. I've got every different, you know, kind of client you can imagine. I've got trust fund kids, I've got millionaire property developers, I've got surgeons, I've got a lot of pilots for some reason. Pilots seem to love me. But the system isn't there for returns. The system is just the lines, the support, resistance, that idea of what happened in the past will logically spill out to the future. What my mentoring side will do is I'll sit you down, we'll have a chat, and we'll see what you want to achieve. And 9 times out of 10, I will get you to that point. But you have to come with the money. You have to invest in yourself. I'm not going to give you my time for free if you don't come with your own investment. And I'm not asking you to, you know, give me the money. You put the money in the account. It's you that's trading it. You just have access to the charts, access to my thinking. And my key is I've done over 1,500 webinars now, well, probably more, you know, written books, you know, hundreds and hundreds of webinars. That's for everybody. These sessions are for everybody. That's general knowledge. You know, you can Google it, you can buy my book, you can do watch a past recorded webinar. The whole idea is that when I do this mentoring, it's with you. Yeah, what people struggle to do in the markets is to figure out how they want to interact with the markets. They're always looking for somebody else to copy. If I do it like him, then I will be good. Yeah? Who did Muhammad Ali copy? Nobody. His own person, but he still had a trainer. He still had people around him. That's what trading is. It's a lonely game. You need to find somebody, yeah, who's been there, done there, got the t-shirt, and tells you how it is. I'm not going to sit there holding your hand, stroking you on the head. Aren't you a good little trader? No, I'm just going to get into the bones of what trading's all about, figure out what you're trying to achieve, get a plan. I'll tell you some little bit of magical tricks, and all of a sudden, you know, I've opened the wardrobe. You're in Narnia. Go off. Be free. Run, little fawn.
Okay. Well, Carolyn says we're up for 14% in 3 months with Steve's help. So there you go. You must be working with Carolyn, which is great.
Yes, the Clarks, I do. I work with them. Yeah, absolutely. Like I say, you know, my client list is long and distinguished, and I have people. Don't get me wrong. You know, some people break the rules, and sometimes, you know, we have big drawdowns. You know, somebody lost a lot of money over non-farm payroll, but we're working together. You know, we're back on it. We're talking. It's different for everybody. It's different for different people. I wish that I could say that, you know, I guarantee everybody 5%, but it doesn't work like that. You have to put the effort in. What the missing part of training is that bit in between the learning. Everyone can listen to a webinar. Everyone can pick up a book. Everyone can buy a bit of software like VectorVest or whatever else. It doesn't tell you what you want to know or what you need to do at that precise point in time. Yeah, there's very few people on the planet that can do that, and I am one of these people. And we'll either get on together and it'll work, or we won't. But all you have to do is open an account with a broker that doesn't trade against you. Yeah, somebody where I'm going to give you, if you do the volumes, 10, maybe 15% of your money back each month. Yeah, and that's it. Then you get time with me. What do you want in time with me anyway? That's going to be worth just sticking 25 grand in an account, isn't it?
Steve, I'm putting there. We're getting quite a few questions. Say, how do we get started? How much do you charge, etc.
No charge. It's free. Just go to steveruffley.com and you have to put 5 grand in. I'll give you my charts, but you can't talk to me. More than 25 grand, you get to talk to me. Above 100 grand, I'll take you out to a Michelin star restaurant and we can have a nice little chat.
Okay, well, I've actually put them in.
There's no in between, there's no bargaining, there's no sub stories. That's it. And I will be absolutely honest again, Simon. This is tick tock. You know, I'm not going to offer this mentoring service for forever. I mean, you'd be lucky if you can get it. You know, if you don't sign up to, you know, in the next kind of, you know, day or week, then all of a sudden it'll be closed off, because I have no shortage of clients, don't get me wrong. And who else, you know, comes on your webinar, Simon, you know, time and time again, giving you all this great, you know, showmanship, and at the end of it charges people nothing.
Fantastic. Okay, well, there's a lot still coming through. I'll put the link in the box if you want to get in touch with Steve. Just fill out that form and he'll get back to you.
Yeah, I mean, there's loads of stuff, you know. You just Google Steve Ruffley. I've got about 8, 9, 10 pages, you know, on the web, you know. So do your research, you know, figure it out, you know, come to me with some intelligent questions, because it's a very fast-moving process. I'm not going to sit here and, you know, kind of say, okay, right, you know, you've got $5 grand, right, let's, you know, strategically plan our future together. So it's not going to work like that. You know, in my experience, I've taken people, you know, from £25,000 accounts to 100, people with 100 to 500,000, people with 1 million to 5 million, right? I've done that. Yeah, it's not easy, but I've done it. I've got a track record. And it's different every time. I can't give you a blueprint of how it'll work with you, because I just don't know. I don't know you. Yeah, but what I can do is we can have a conversation and some dialogue, and I quickly understand what kind of trader you are based on what kind of people, because there are only 3 kind of people in the world that I've met. Yeah, and not all of them make good traders. All right, Simon. Listen, I've got to be rude here. I've got to actually finish this, because I've got yet another call that I've got to jump on now with somebody to sort out this thing in London. So have you got the ability to cover me for the next 5 or 6 minutes?
Absolutely fine, Steve. Thanks very much for joining us. It's great to have you.